Hello, welcome to the first episode of Purple Ventures Zoom video podcast series. My name is Jan Staniak and my dear guest is Miroslav Boublik, managing partner of London-based financial services capital. Miroslav, may you please introduce yourself to the audience?
Sure, absolutely. So my name is Miroslav Boublik. I'm a born Czech, have spent 15 years in the United States. My early career was spent in technology. I have a computer engineering degree, have worked for a couple of companies like IBM, Young and Rubicam in technology. Then I ended up going into business school and after graduating got a job with McKinsey, but in their business technology office in Silicon Valley. Where I also had the pleasure of starting a company, selling it, and ultimately returned back to McKinsey, but this time in Prague, which is my ancestral home. And I spent the rest of the career going back between technology, banking, and investments. My banking career was with Alfa Bank, which is a Russian large banking conglomerate. It's the largest private sector bank in Russia, and with BNP Paribas in Ukraine, in their Ukrsub subsidiary, where I was the first deputy chairman. And the last part of my career was in investing ever since 2010, or actually 2005 if I count angel investing career. I've been investing before founding Financial Services Capital with my partner, Matt Hansen. I established Home Credit's venture capital arm, so corporate venture capital, and invested in a number of companies which would be considered fintechs.
When it comes to financial technologies and financial services in Europe, what do you see the state of it at the moment?
I think it's a very exciting time today because financial technologies or fintechs are changing the way financial services are presented. We have seen the rises of the likes of Revolut and Wise, companies that are taking advantage of inefficiencies in the financial sector, and they're fundamentally changing customers' expectations of what they expect from their financial services provider. Our belief is that the fintechs are quite useful for changing expectations and showing customers what can be done, what's realistic. The problem is that 98 or 99% of the balance sheets are still going to be with traditional legacy banks, consumer finance, asset managers, and those are much harder to change. We as Financial Services Capital believe that the changes within those institutions, in the traditional legacy institutions, are going to be the most impactful. So adapting modern technologies, but applying them to the legacy, which can be 50 years old in some cases. Systems, the core banking systems, for example, are from the 70s and 80s. There's still 73% of core banking systems are still written in COBOL, which is de facto a dead language. And that has to be addressed. Those are fundamental changes that have to be addressed. And that's much harder, but much more impactful. Most people are not going to switch their entire financial services relationship to a new upstart.
And as of 2021, what are the key trends observable in the fintech or financial services in Europe?
So I think you're seeing that the passporting or the ability to provide financial services in the European Union is starting to bud. You're starting to see players that offer similar services in all the European countries. Not always at the same time. They launch in one larger country. It used to be UK was the favorite country, Germany, and then they expand to other countries. You see cherry picking somewhat. So you see, Revolut went after the FX market and used that as a hook to get customers. Wise, or it used to be called TransferWise, used the fact that international wires were very expensive and addressed that market. So they're cherry picking. There's also some technological advances. So you see in Europe the Payment Services Directive, the second Payment Services Directive known as PSD2, is coming to its own. It started with the account information service providers, so you could get account information across multiple banking relationships, and now it's the payment initiation, PISP, that's the next kind of horizon. So you're going to be able to use one app and control payments or transfer money between multiple institutions. And that's going to present challenges for the traditional players, but it's also going to present big opportunities. There's also a number of developments in the asset management space. You see the rise of robo-investing, although that is very early and I don't see as much traction. I would expect that over the next 5 to 10 years, it will become much more mainstream. And we can go down every part of the consumer finance space. I think the whole concept of embedded finance is what is driving this. So bankers and financiers historically, I would say we've been full of ourselves because we thought people care about the bank. People don't care about the bank or the consumer finance provider or the insurance provider. They care about what it gives them, the ability to buy something. If you like this house, you need a mortgage to buy a house, right? Most people do. So the mortgage is not the end all and be all. It is a tool to allow you to accomplish a goal. Same thing with buying a car, an auto loan, savings product, saving for college, things like that. So it is making sure that it's seamless, that it accomplishes the goal for the customer and the bank doesn't, or the financial institution doesn't get in the way.
Mm-hmm. Would those trends differ much in US or in Asia?
There are differences, certainly. I think they're sparked by the fact that US has, for example, a different payment system. The concept of European payments, we send money to an account. The US basically emulates drawing a check upon somebody's account. So one is push versus pull. But in the end, the goal is the same. Make sure that the customer has the easiest experience and they can generally now in their pocket solve all of their problems. And that's in the consumer realm. It's going to be similar in the corporate realm, making sure that the friction is lowest. Of course, there's different regulation. Of course, there are different things, but we can see that the globalization of financial services is not globalization in the sense of institutions working across the world, although there are some big institutions that work globally. It's more about converging. So the PSD2 initiative I mentioned, there are similar initiatives working in Asia. Australia actually took it a step forward, so it went beyond, UK went beyond with open banking, so that's kind of PSD2 plus, and Australia took it to the next level. They actually made data available not only from financial institutions, but also from telecom providers, utility providers. So it's actually converging not only within financial services, but it's encroaching on other industries, so to speak.
What role could the new entrants, startups, actually play in those trends and in changes in the future in the financial services and also in those enabling technologies?
I think it's actually a very important role. I started by mentioning a couple of the names of fintechs that we know and love. They're changing people's perception on what is possible. And those customers then go to their mainstream institutions and are asking for the same level of service, same level of low friction that they would get with fintech. So it's that it is addressing specific problems. Generally, the large financial institutions are slower, as any large institution is slow. And so having these fintechs, it's like a tugboat. They're basically forcing them to go in a direction where they normally wouldn't necessarily go by themselves. And sometimes they collaborate with the large institutions, so a fintech and a bank. Sometimes they take over a certain space and they disintermediate the large financial services, and sometimes they get acquired. Oftentimes you see large institutions now setting up investment funds, venture capital funds that invest in those services. We have I can't mention the name, but we have one institution now that is quite early. It's in Series A, and it's already getting offers from large institutions to be acquired because they have a very good technology. And so you'll see this competition, investments from large financial institutions. They're trying to, the large banks, large insurance companies are trying to receive the innovation from the outside because it's very hard within a large institution to push innovation.
If we stay and go deeper in the startup universe, what qualities of the founders and their companies, their startups, do you look for when deciding to invest? Or
so I think the most important, obviously, intelligence is important. Obviously, integrity is important. But I think the most important quality is perseverance. And this is why you would see a lot of Silicon Valley venture capitalists invest in serial entrepreneurs, because they have proven the perseverance. They have proven that they have what it takes to make a startup successful. It's also important, obviously, to see a commitment, and that depends. I mean, we invest in later stages, but I also invested in early angel investment, and even friends and family with some of my close friends. And those are really, what's important is that you see the commitment of the individual. So when, as a VC, I would see a group of people coming together for a meeting and saying, we're going to quit a job when we get financing, that's a no-no for me, because I want the people to be out there, to be doing it, and to have pushed it forward, not to hedge, not to have, okay, we are going to do this, but if this doesn't work, we're going to keep our corporate jobs. I want them quitting the corporate job if they believe in the idea and pushing themselves to do the right thing, because that's really what it takes to make something successful.
Mm-hmm. Would there be other reasons why you would not invest into certain founder or startup?
I mentioned integrity is important, and I think to me, it's been important in my corporate career. If there was somebody that was a very strong expert, but I couldn't trust their integrity, I wouldn't hire them. Because at the end of the day, you can teach people skills. If they're smart, they can learn just about anything. But integrity is innate. It's an ethical basis. And I think for me, that's one of the key things. So if I see people prevaricating, or there are some facts that don't jive that in between what they told me, and then I see a data, and all of a sudden things are very different, and I see that as a pattern, that's a red flag.
Can you evolve more on that? How do you get with a limited amount of interactions, right, with the founders? How do you get that? How do you turn on that sensor if you don't have many interactions with the person?
So I think, if you look at a venture investment, obviously private equity is even more involved than that. It's you do much deeper due diligence. And in private equity, it's not as important. The founders are not as important generally, because you have a cash flow positive institution. It's an institution at that point. In the venture capital realm, you are doing due diligence on the institution, but you're also doing due diligence on the founders. You're talking to them. You're getting a sense. So, you ask questions, and then you go back into the virtual data room that they would inevitably have to set up. And you don't see that those, there are facts that they told you that don't quite match. And you then start asking deeper questions. And, if you're an experienced investor, eventually you see that something is not right. So I don't want people to give me the nice points, because I know in every startup there are difficult points. There may be things that are not finished. If I may call their customers, and obviously they've given me a reference, so the customer is prepared. But there are questions you can ask about certain things, and ultimately you'll find out that some things are not there. I would rather them tell me, okay, here is something that works for us. Here's something where we still have to continue working. Nobody is perfect. No team is complete in the early stages. So I'd rather hear that up front, and that builds credibility.
What are your lessons, your own lessons learned from the early days when you had your own company?
I think the lesson that I give to entrepreneurs, I mentor and entrepreneurs, certainly I'm on boards, is so certainly first-time entrepreneurs. The highs are extremely high and the lows are extremely low. So if you haven't been an entrepreneur, if this is your first time around, this is going to be gut-wrenching sometimes. The highs are, I've never done drugs, but I can imagine that some upper would give you terrible highs. But you have the gut-wrenching reaction when you're running out of cash. You don't know where your next paycheck is going to come from, how you're going to pay your people. And those situations will be there. I actually think that every successful company, in order to be successful, has to go through this period. It has to have a period where it thinks it's going to not make it. The founders have to have a gut-wrenching reaction. I almost feel like if you just had a smooth sailing, to me that's a worse thing, because you're about to get into this gut-wrenching situation. You're about to have that down, the trough in the development, because it comes sooner or later. And so the people, the entrepreneurs that will make it, and for me that was, making it through that was hard, but it's actually then I had the benefit of going back and forth between the large corporations and starting companies, helping companies. In the large corporation, it's actually much easier then, because even if you have big problems, even if it's stressful, it's not nearly as stressful as not knowing where your next paycheck or how you're going to meet the next payroll for your people.
And on the same or similar note, what mistakes do you see the founders making?
I think that what I see is certainly at the venture capital level is founders worry about one thing, which is valuation, more than the holistic picture. So I think it's important. The world today is awash in money. There is quantitative easing happening everywhere. You have literally assets are growing, the valuable assets are growing because there's no other place to put money. So money is out there, but having, if you look at the overall picture, getting money at a high valuation and picking the wrong partner could be life-changing or life-ending for the startup. So it's actually worse if you have very high valuation and then your next round is a down round. If the partners that give you the high valuation don't add value. So look at the holistic picture. Look at who the partner is, who the venture capitalist is. Can they help you get customers, get partners, get credibility, and eventually help you with the IPO potentially? That's important. Are they going to put the person who's going to sit on your board? Is that person going to be somebody that is going to understand your business, that's going to spend the time working with you? Or do they have 15 board seats, and are they kind of the fly by night, or no, just going from board meeting to board meeting and saying few truisms? So look at how your partner is. Don't focus as much on the valuation. Oftentimes focus on other things in the term sheet. If you look at, you can have a great valuation, but then there are other terms that venture capitalists are quite good at putting in and that the entrepreneurs start ignoring. Full ratchet anti-dilution protection, for example, could be very difficult for you if you have to take a down round. There are some other things, there's ESOP, top of ESOPs that are important, and that basically lowers your valuation as well, potentially. So don't focus on just one number, focus on the entire relationship and focus on the entire term sheet.
Since this is the first episode of the podcast or the video podcast, may you please high level describe the startup funding journey from the very first skin in the game of the founder to the later stages?
Absolutely. So obviously, first you have to have an idea. You have an idea on what you want to do, how you want to change the world. Oftentimes you have to have done some work on it, so you have to do some research, and you do that. If you have a job or if you're a student, you do that together with your job or together with your school. Once you have the idea, fleshed out, you understand what the market is, you understand what the potential is, and potentially if you can program and it's a software startup, you could already have a prototype built. You go to the next stage, which is friends and family. The friends and family is much easier in the US than it is in post-communist countries because people don't necessarily have the level of wealth. Our grandparents and our parents didn't have the benefit of saving their entire life. So you don't necessarily have this pool of money. So you may have to jump that stage and go directly to angels. Business angels are, again, there's fewer of them in Europe, in Central Europe, than there are in the United States, but it's becoming a very vibrant community. So you get, with the friends and family or the angel money, you get to a stage where you have first discussions with customers, you have something that's a alpha or a beta level product, and you start getting people interested in potentially paying for it. Then you go to the next stage, which is a Series A, where you already have some business traction, and then it goes up to B, C. There are some businesses that have gone through D, E, F rounds, but generally, between an IPO, you would have probably 3-4 professionals or professional series, so A, B, C, D, before you go to an IPO or you get acquired.
Where do the pre-seed or seed terms come into the play? That's in between the family and friends. Is that the angels, or where did that come from?
So this is actually different between the different countries and different continents. So United States, the seed was always kind of, you could say that the angels and seed kind of commingled. So you're working with angels, or you're working with seed investors. There has been over time inflation in the series, in the valuation. So many people have raised seed funds, and because the amounts of money they raised, they had to put more money to work. So the seed rounds became larger, the valuations became larger. So it's kind of moving up, where the angels are able, again in the US mostly, or in North America, able to put in more money. The seed funds are able to put in more money. So to me, that's kind of, seed is between an angel and Series A, but oftentimes it could be either an angel or a Series A. So it's a bit of a fungible understanding.
Let's say in the European context, these funding steps, how large these fundings tend to be, these rounds, and where did the money come from?
So obviously friends and family, depends. Friends and family, again, in Central and Eastern Europe, a lot less prevalent because there's not so much money. But it's, it was on the order of tens of thousands of dollars or euros. Let's say the seed or the angel could be hundreds of thousands of euros. Again, it's been moving up. So now you have pre-seed and seed that are single millions, and seed is getting into tens of millions, which is ridiculous. But I think that's mostly in the US again. So in Europe, you're moving from tens of thousands to hundreds of thousands to single millions to tens of millions then for the professional series, for investors. So, and again, it's not dogmatic. It depends what type of tractions you have, what type of what customers, potential customers you have. Certainly in Europe, there's more focus on getting to profitability quicker. US venture capital investors invest more in the idea, and oftentimes you've seen companies that haven't been profitable even go public. So that's very different, and it's been changing over time.
And the money would come from?
Obviously the seed investors or the angels. So angel investors, it comes from it's their own money. So this is oftentimes entrepreneurs or successful corporate executives that like to help companies, that like to invest. For them, it's more meaningful than putting money into public markets, because they can actually use their experience to help companies, and they like that. And it's great when you have a vibrant ecosystem of people that have been successful entrepreneurs, exited, received significant net worth, and part of that net worth goes back into the system, and the ecosystem becomes more powerful, more vibrant. Then once you get into even now pre-seed and seed funds, it's oftentimes these are now becoming institutional. And certainly once you go into the venture capital and the private equity space, these are so-called limited partners. This is just an artifact of the structure. It's a partnership structure that has a general partner, GP, which manages the money, and a limited partner, LP, which provides the money. They're the investors that provide most of the money to make investments with. These LPs are globally large, and especially again in the US, because that's where this concept came from. It's endowments, so school endowments, sometimes hospitals. You have pension funds, so you could have municipal employees' pension funds. Some of the largest ones are CalPERS and CalSTRS. These are California public institutions, public pension funds that allocate a lot of money. You may have insurance companies. You may have high net worth individuals that are if they're quite wealthy, they will set up what's called a family office. So family offices, endowments, and insurance companies and pension funds.
From the founder's perspective on these funding steps, what is the value the founder should be gaining from in those various types of investors?
So I think in the angel realm, so friends and family, it's the first money, and it's basically people they like you. So you probably are not going to get a lot of value unless you have somebody in your family that's an experienced entrepreneur. It's more about just getting you started. The angel and seed investors should be helping you with the basics of setting up a company. We haven't talked about incubators. I'm not a big fan of necessarily of incubators that just provide office space or some legal services. There are some really successful incubators out there that can help you with really understanding of what the startup ecosystem and the startup path should look like. And that's kind of in those early stages. Series A, you're already getting into professionalizing the company. So it's about trying to help you with hiring, trying to help you with partnering, building a product, introducing you to the right people. And then as you become into the larger and larger series, you're starting to get closer to an exit. And that becomes one of the foci, or the focus of what the investor can help you with.
How important is to keep the founders motivated throughout the journey, right? So they, let's say, keep some sizable stake in the company.
So obviously you invest in the founders in the early stages. So you want them to be self-motivated. What you don't want to happen is that because of the market was harder, or they didn't raise enough money and they had to get maybe even a down round, which is obviously not great, they were diluted to a point where they don't have a meaningful stake. So at that point, you would look at it as a venture capitalist, and you would, you often ask to top up the employee stock ownership plan, the ESOP, and you would use the same shares to make sure that the employees have a decent enough stake to make it worth their while, because it is extremely hard. It's not a 9-to-5 job. They're going to have to work really, really hard. And if they don't have a meaningful stake in the company, obviously they're not going to be as interested. So it is important to make sure they're motivated. But if you do things right as a founder, and if you raise the money at the right valuations, you should, through this process, have enough of a stake in the company at the end of the process when you're exiting to make it meaningful. But as a venture capitalist, you have to be mindful of that. And if there have been some trip ups, and those happen, sometimes because of your fault, if you're a first-time entrepreneur, you can't know everything. You may have gotten into some bad advice, or the market went south, the macro environment got worse. So and it's one of the important pieces that an experienced venture capitalist would focus on.
Miroslav, what are the key roles of a board member representing the interest of the investor, but also, helping the founder to succeed?
So as a board member, obviously you have fiduciary duty to all the shareholders. Then, of course, as a representative of a fund, you have fiduciary duty to your own investors, and you also are there as oftentimes the gray hair. So you are trying to balance those three constituencies. You need to make sure that the business is going in the right direction. Sometimes you have to make difficult choices. You have to actually coach the CEO out. Oftentimes what happens is that the company gets to a certain level, and the CEO that was the founder no longer has the skill set to take the company forward. Now, and that happens a lot of times. I mean, you see the examples of where they're successful, when the founder is successful, all the way through to the public company level, and we all know them. It's Facebook, it's Tesla, but actually most companies at some point you have to replace the founder. And obviously you want to do that with the founder, because the founder will be a major shareholder in the company. So you have to make them understand that they need additional skills. And that's one of the hardest things to do as a board member. But you also have to, obviously you don't start with that. You want the founder to be successful all the way through to the exit, all the way through to go in public or selling to a strategic investor or financial investor for that matter. So you help them with the gaps that they have. If they were, if they're students, a lot of times that happens. You have now, especially nowadays, you have students starting companies right out of college. They have never worked in a corporation. If you have a serial entrepreneur, they may not have worked in a corporation. And so they have the right skills for the early stages of the company, but then when you're professionalizing the company, the stuff, the processes you may be putting in may look like bureaucracy to them. And yes, they're bureaucracy, but when you scale past, dozens of employees into hundreds and thousands of employees, you need to have proper processes to manage that corporation. So there are some really important stages, and depending on the size of the company, the challenges are different.
Would you evolve more on what you think are the best practices in governance of these growing startups?
So I think it's obviously you want to make sure that you have people that understand different aspects of the business, that people are active in the business, because in the early stages you really need to be. This is not about showing up once a quarter. You need to be quite involved. It's at the early stages and quite late into the game. The founders are the driver of the company. The investors are there to help, but the motivation, the drive has to come from the founders. That may be different from a private equity setup, where you're already hiring professional managers, and a lot of times the founders aren't there. They may have exited. The company's already profitable. It has found its own niche. You don't necessarily have to. You may have to improve it, but you don't have to change anything. Whereas in the venture capital and pre-venture capital stages, it's all about the founding team. So the founding team is in the driver's seat, should be in the driver's seat, and the investors are there to support it.
When it comes to support of an investor to a founder, let's say we're around Series A, what is this healthy involvement for both the founder and the investor in terms of time, for example?
I think I think it varies. It really varies on what the challenges are for the business, and sometimes the business may be doing fine for a bit, and then it hits a rough patch. It may need to do a pivot, change its business model, and so a proper VC should have the flexibility to step in, help the founder when necessary, and pull back, so they're not hovering, so to speak, looking over the shoulder of the founder. So give the founder enough space, but at the same time, if you see that there are issues and there will be issues always, that the founder has problems dealing with, help, but the idea is to be helpful, but not to be overbearing. And each startup is different. You can't. I don't think there is a cookbook that's universal across the board. It's also, I mean, it's important that the founder and or the founders and the investors find a established level of trust where you can have open communication both ways. You can send difficult messages back, but you also understand when you need to help, and the founders should be willing to ask for help. Nobody is perfect. Nobody knows everything. So for the founders, don't be afraid to, if you have the right investor, if you found the right investor, don't be afraid to ask for help. Because once the investors are in your cap table, you're aligned. Everybody should be aligned on making sure it's successful. It's not about ego, admitting that you did something wrong or something is not going well. It's better to do it early on in the game, and be upfront.
So could it be somewhere in between, like a weekly to monthly engagement?
I think yes, absolutely. I mean, I have startups where I'm in daily contact, and I spend quite a bit of time with the CEO. But it's the CEO asking for those. He's pinging me on WhatsApp, asking for help, or can we talk about this? Can we do this? I have startups that basically you have monthly board meetings, sometimes even quarterly board meetings. But I think for a startup, that's too long. You need to have a conversation at least once a month, and a relatively deep conversation. So I think you should be spending at least a day a month on a startup as an investor. And in early stages, it may be more, but unfortunately, it's generally the opposite. In the early stages, the amount of money, the amount of work involved is much more, but the amount of money that is being invested, and hence the expense of the investor time is you're not willing to spend so much money if you put in 50,000 as if you put in 5 million necessarily, because you have to balance that. But sometimes it's the opposite. A large corporation may not need that's running well may not need your involvement as often.
What should the founder, at what personal qualities should he or she be looking when it comes to people representing the investors?
Well, I think it's the most important is personal chemistry. If that's not there, if you can't get along the person, if you're going to be spending some difficult times together. I mean, ideally you don't have too many of those, but you have to count on some difficult times to be there. And if you can't be open with the person, if you don't enjoy working through problems at the best of times, then it's going to be difficult in the hard times. And then, of course, you need to look at the experience. I like venture capitalists that have had entrepreneurial experience themselves, because they can help you think through that, and it can share battle scars. I finished Harvard Business School, and many of my colleagues went straight into private equity or venture capital, and they had very stellar career, but they oftentimes started from an excellent university, an Ivy League university, Stanford, MIT, top 10 university. Then they ended up going into a corporation like a Procter & Gamble, or going to McKinsey, and then they went to business school and started in venture capital. Now, they're extremely smart and they've probably seen a lot, but it's hard to empathize with a startup founder if you haven't been through the experience yourself.
Mm-hmm. If we stay on this note, so you yourself have excellent education. You're a graduate from the Harvard Business School. And what do you see in 2021 or in this decade, a role of a formal education in both, starting a company or running a fund?
I think it's important. I think a formal education, of course, different levels of educations have different value. So I prize my computer engineering degree because engineering as such teaches you to have structured thinking. You have scientific method, and you have, as an engineer, you become very pragmatic, and I think that's useful in any walk of life. So I highly encourage having some formal education. It's very important these days. Business school is quite useful, and in this case, Harvard Business School. I love the case method because you discuss what other people went through. Obviously, it's simplified, but you can see 800 different cases over the period, something like that. And so you would have seen a lot of different things. You can never have that real life experience, right? You'll never be able to do that. And combining that with a real life experience, then it's much more powerful. So I think it's important. Now you see some of the most successful entrepreneurs have dropped out of college. Bill Gates, Larry Ellison, and others, right? So, but I think they dropped out of college because they already had something going, and they believed in it so much that they basically said, well, I would be wasting 2 years of my life. I can go build this thing that I believe in. That's a different story than not going to college to begin with.
They actually say the indicator whether you will be successful is not the fact that you have finished the good university, but it's that you have been enrolled to the university.
I think in many cases that's true. I mean, the enrollment process and the number of people that they accept as a proportion of people that apply. If you have a good filtering process, and it's the same for the best colleges. It's the same for institutions like McKinsey that have a 3-stage interview process where you interview with a large, fairly large group of people. If you've gone through the whole process. I think that gives you some comfort. I mean, these are experienced people that see thousands or tens of thousands of applicants, and so the filter in itself is important.
And if we stay on the note of having some part of your career working for an let's say excellent consultancy firm, how does that make you better investor or founder?
Well, I think as having, I mentioned Harvard Business School cases being useful, and then having the practical experience. The consulting part is something in between, right? So it's kind of a stepping stone. So you have theoretical, you read about what other people did. Then as a consultant, you're helping them do it. You're actually in there and you see the outcome of it. And then when you do it yourself, so first is theoretical. The second one is you're helping somebody do something, and the last stage is actually doing it. So I think it is an important stepping stone. It's not a must-have, but I found the experience at McKinsey was a great extension of business school.
And when it comes to business school, at what time in life is it the best to go for it? Because you mentioned that if you go straight after the bachelor degree, that you may not have, they may not be the right timing.
Yeah, the top schools actually almost enforce that. You need to have some level of practical experience. They, a couple of years minimum, and I think that's the right approach. The reason for the case method, it's important because your education is formed through a class discussion. And if you have, roughly 80 people in your class, depending on what school you go to, and that uses the case method, a lot of it is about participating in a conversation, and somebody in that class probably was in the industry that you're talking about. So you not only have the professor teaching you, you have other classmates that have been in that industry teaching you, and that's very powerful. So I think it's between the mid-20s to 30s is valuable. After that, it starts diminishing. The value of it starts diminishing because you get a lot of practical experience that replaces the business school.
If we turn page and go to the venture capital world or private equity world, what's the hardest part of starting a fund?
Well, I think the problem is that every investor, every LP in a fund wants you to have a track record. And how do you get a track record without first starting? So it's a catch-22, and I think that's where you have to work for somebody that has and establish at least, you may not have attributable track record. You work with somebody, but you're learning from somebody. It's an apprenticeship business, and so you have to learn from somebody. And Of course, it's not easy to get into a venture capital or private equity firm. You generally have to have some amazing experience, great business school, and obviously in Europe, and especially in our part of the world, there are not that many private equity or venture capital firms to begin with. So the universe of where you can learn this is extremely small. The other path, how to get in, is be an entrepreneur. So if you have been already a successful entrepreneur, sometimes you end up going into a venture capital firm. And so, it's the hardest part is getting into the business one way or another. Raising your own fund, you need a track record. And in order to get a track record, you have to be in the business.
What roles, jobs are there on the investor side, the fund?
So obviously, a partner is the highest level, right? And to be a partner, you already have experience. But you have analysts or associates that help you do the analytical piece of the business. You have people that are paralegals that can help with structuring the deals. There are people that help with actually closing the deal. So there's a lot of documentation, lot of due diligence, a lot of financial analysis that has to happen. And there's also technical expertise, especially in the technology venture capital business. So you can draw upon a network of people. You can also, some firms have in-house experts. So that's kind of the broad universe of opportunities in a venture capital or a private equity firm.
Mm-hmm. So one way how to get into it is to start as an analyst or paralegal, for example.
Absolutely, but even there, you have to, the number of people trying to get into the business versus the people that actually get a slot it's a much lower chance than even getting into one of the top business schools or top universities in the world.
How do you see the evolution of the venture capital or private equity in Europe in this decade?
So I think I'm hopeful. I'm hoping that we will get closer to what the U.S. venture capital scene, especially Silicon Valley, looks like. We already see that. We have some very successful fintechs. We have very successful startups in Europe, and success breeds success. So I hope that this will create additional opportunities. New firms will come in, and I'm hoping that continental Europe will start getting bigger traction in terms of having its own venture capital scene, because frankly, most of it today was in London, and Brexit may create opportunities for this. There is a vibrant scene in Germany, in Berlin, Munich, but beyond that, it's relatively scattered. So we're a large continent. Compared to that, we have a long way to go. But I think that because we now have some very successful startups coming out of Europe, hopefully we'll have some venture capital and there's plenty of private equity in Europe, but not a lot of venture capital.
Miroslav, for the next 12 months in your life, both maybe personal or business life, what are the challenges or plans you have?
So we've started a firm 3 years ago, and we're now coming into our own maturity for a startup. It is a startup, although it's a very different startup. We've already invested in 4 opportunities, and we're now basically professionalizing the firm. So we're looking to start doing our mainstream funding. We're also working on, we're already large, we have 5 partners and over 25 people. So we're now looking at putting in processes and operationalizing a lot of the things that we know needed to happen, and we just didn't get around to it. So it's very exciting. It's an exciting part of the journey. And I do like this, the startup journey, the startup path. So once we're professionalized, of course, there will be opportunities to help other startups. But in this case, we're working on our own. So it's very exciting.
Miroslav, thank you very much for your time.
Thank you for having me.